What's going on YouTube? In this video, we're going to go through Enphase. They just reported their Q3 earnings, and in the post market, they are down basically 17%. Currently sitting at about 80-ish dollars per share. So Enphase forecasted for this quarter, for third quarter, to be in the range of $550 million to $600 million in revenue. They came in at 551 million, so on the lower end of what their forecast was. Now, the downside is their future forecast for Q4. Analysts were expecting 600 million for a future forecast. They gave us a fourth quarter forecast of 300 to 350 million dollars. So half of what analysts were expecting. That is why this stock is down 17% in the aftermarket. Although that might be the reason, or is probably the reason why the stock is down, the company still did pretty decent with its overall financials for this most recent quarter. Maintained gross margin, and actually gross margin I think is slightly up, of 47.5%. Operating income of $118 million, net income of $114 million, free cash flow of $122 million. So still positive free cash flows, so that's obviously very good. And they've also got $1.8 billion in cash. So they've got plenty of cash, even if they pull out a negative quarter or two, which is possible, especially if they're only going to do $300 million in revenue next quarter. That's potentially likely where they might be negative free cash flow. But they've got, if you think about it, how long do you think? Do you think we're closer to the end of interest rate cycles or the beginning? So obviously you have to think we're at the end of the cycle, and next year, about this time next year, we're looking at potential rate cuts. I think that about this time next year, maybe even a couple quarters or a couple months before this time next year, maybe May, we might see some softening within what the Fed is doing. As soon as we see that softening, I think Enphase is on its way back up. But it's going to be a very bloody, beaten down path until I think that time frame, because of our future forecasts on revenues. Nobody's going to want to own this stock until things start turning around. So those of us that do own and are continuing to hold, it's going to suck. It's going to be painful, but you just kind of got to just look at the company you're buying. Don't look at the dollar amount that where it's trading at. Just know that what you bought is a good company. It's not like a GameStop that's going to go bankrupt. This company could go bankrupt, but it's got $1.8 billion in cash. It's still positive free cash flow for the meantime, and it still has a good business model to it. It's making money still. And plus, if solar is going to be hitting this much of a brick wall, it might get rid of some of the competition. Nobody's going to want to start a solar business, and Enphase already has its foot in the door and already has customers. So I think, and plus we know this thing can do $2.8 billion in a year in revenue. So we can see that over here. Trailing 12 months did $2.8 billion in revenue. Forecasted potentially for the next 4 quarters, which I find unlikely, but we might do $1.3 billion, right? So we're looking at 2021 levels. So in 2021, we had total cash of about $1 billion. We do have a little more liabilities now than we did before, but that's the other thing too, is like our total liabilities for the next 12 months is $744 million. We've got plenty of cash to cover that. Plus, they're still making money. They're still positive free cash flow. And on top of it, they do have a share buyback program. Will they buy back shares right now? That maybe. I think it's really going to depend on what their forecast is for the next couple quarters. Are they going to start to see some strength come back to the solar industry? You know, that to me is going to be kind of a gray area. I'd like to see them buy back shares, but I don't want to see them buy back shares and then they soak up all of their current revenue or all their current cash. I'd rather them just not buy back shares if it means putting the business at risk, obviously, of potentially, running out of cash. Maybe they will use some of it for cash, but they also have some liabilities they got to pay for as well. We know they got about, basically, if they pay for all their liabilities, their short-term liabilities, it leaves them with about $1 billion. But I think that $1 billion will keep them afloat. As long as they're positive free cash flow or close to it, we can see in 2021, they were still positive free cash flow. They were still positive net income. They were positive net income in 2019 of $624 million of revenue. So obviously they've got more expenses these days. In 2019, they had only 76 in SG&A. Now they're 384. But even if they're somewhat slightly negative, they're still going to be okay. Yes, they're not going to be making a ton of money. They might be losing a little bit of money, but I think they're going to understand that. They're going to know that, and they should be able to maintain that. The other thing too that is in their recent report is that their CapEx, their capital expenditures were $24 million in the third quarter compared to $44 million in the second quarter. So their CapEx is going to shrink. So that'll also help with free cash flows. And I think honestly that this company free cash flow to net income is just going to be barely just kind of teeter-tottering between positive and negative is my assumption on that. So right now we're looking at 2021, they had 143 million shares. We're currently at 145 million shares. Share repurchase program up to $1 billion of their common stock. So in the third quarter, they bought back 846,000 shares at an average price of $130 per share, approximately 110 million of that 1 billion. So they got $890 million left to buy back. Now, obviously, we don't know what they're going to do with the rest of their buyback program they got going on, but it depends on how they're looking at it and what they're forecasting for their future as well. But let's assume that maybe they can use half of that. They can use 500 million, or they choose to use 500 million of that $1 billion they have set aside. So if they use that $500 million, that could potentially buy back about 5 to 6 billion dollars, or sorry, 5 to 6 million shares. So then that would decrease our share count compared to where it was in 2021 in the meantime, assuming they do that. And then on top of that, if you look at 2021, when they completed their fiscal year of 2021, they were roughly trading. We can see somewhere in this range. They looks like throughout 2021, they traded between about 120 to 100 or $280 per share. So even if we just stay on the low end, say $120 per share, because obviously we're forecasting a lot less in growth right now, that's roughly what we can possibly expect. So we can pretty comfortably assume that being that the fact that we're trading at about $80 per share, we're trading at 2020 levels, and we know the future forecast of what this company can do. So once things decide to turn around, I think this will be, this is going to be one of those that's going to come back up to $200+ per share. When we value this company, it's sitting at about $230, I believe, per share in value of fair market value. It's sitting about where that green line is. In the shorter term, it's going to be painful. It's going to suck. And when you look at the big picture, this is just going to be probably a couple month period, 4, 5, 6 month period. And then next thing you know, this thing will be starting to trade back up higher and probably make its way back up to $200+ per share, because it's got the customer base. There's probably going to be other solar companies that are going to get pushed out of the market and probably go bankrupt. It's capitalized well enough to withstand some tough times in the future. So I think that's pretty important to realize and understand, that they've got $1.78 billion in cash. They've only got $700 million in short-term liabilities. They're still positive free cash flow. Even if they use their positive free cash flow that they have, maybe it's like 100 million, whatever that is, for the next few months, or well, next quarter, and maybe they only use that $100 million in positive free cash flow to buy back shares. But regardless, now would be a great time for them to do it, but they probably won't do it until they start seeing some positive, more orders coming in, and people starting to feel more comfortable with solar. So, it depends on how they're looking at it. They might just sit on the sidelines and say, no, we're not going to buy back any shares until we start to see more orders coming in. So I think this is unfortunate for the short term, but I think in the long term, this will pay off and everything will be just fine. So I hope this video brought some clarity to some of you. I know for me, sometimes I need somebody to do that for me, and I hope that this one helped for you guys. If it did, drop a like, subscribe, and we will be back later this week with some more stock analysis videos.